Your credit card statement says 22.99% APR. That is not the number you're actually paying. Banks calculate your real interest using a formula they never put on the front page. By the end of this video, you'll know exactly. Step 1. Your APR is a yearly number.
But banks don't charge interest once a year. They charge it every single day.
To do that, they quietly convert your APR into something called a daily periodic rate. Here's the math they don't explain.
Take your 22.99% APR, divide it by 365. That gives you a daily rate of roughly 0.063%.
Small number. Doesn't look scary.
Until you realize it's applied to your balance ping.
Everyday kale.
Automatically.
All right, let's get to it. The numbers look good.
Managing your bills is easier than ever. We help you consolidate your statements in one place.
Step 2. And this is the part almost nobody knows.
Banks don't apply that daily rate to your statement balance.
They apply it to your average daily balance across the entire billing cycle.
Let's say you had a $3,000 balance for the first 20 days of your cycle. Then paid it down to $1,000 for the remaining 10 days.
You'd assume your interest is based on $1,000, right? It's not.
Days 1 through 20 equals $3,000. Days 20 was $3,000. Days 21 through 30 equals $1,000.
Average daily balance, Brentrin, Aus 30.
To bid $2,333. That's the number your daily rate gets applied to pro. Not the $1,000 you think you owe.
This is what you think you owe versus what you're actually charged on. $1,000 versus $2,333.
While the green check signifies completion, the red flag indicates a critical error that needs immediate review.
Securely transfer funds and pay your bills instantly, wherever you are. Managing your money has never been simpler. Step 3. This is why paying the minimum feels like running on a treadmill.
Minimum payments are structured so a small slice goes to your principal cane.
And the daily compounding never stops working against you in the background.
Example. On a $3,000 balance at that same rate,
A 2% minimum payment barely covers the interest that's already accrued that month. You're not paying down debt.
you're paying rent on it.
We apply the treadmill metaphor to ensure consistent retention and growth.
When managing your bills, you can choose to pay the minimum due, ensuring flexibility while avoiding late fees.
Remember, the red portion highlights the interest paid over the life of the loan. So who actually sets your rate?
So who decides your specific rate? It's not random.
It's the prime rate set by the Fed.
Plus a margin your bank adds based on your risk profile.
Remember the underwriter from our last video? Remember when we looked at the underwriter's desk? Wait, my credit score is 780. Why was I denied? Because the black box algorithm said no. Denied instantly, without a human ever looking at it.
This is where that risk score comes back. Your margin isn't fixed. It's their bet on you. One move that actually works. Establishing a powerful presence.
Pay down your balance before your statement closes, not just before your due date. That lowers the average daily balance the bank calculates from Player, which lowers the interest you're charged before it ever hits your bill.
Next time, why your bank actually wants you carrying a balance.
And the one product they'll push to keep you there.